Assalamu alaikum friends. Welcome to question 21 of SBR from your revision kit, Kaplan revision kit, Jonjon. So let us go through this. First we'll start with the requirements, but I'm just going to skim through the subheading so that I know that these are the types of questions that I'm asked. For example, first is the background. Then we have intangible assets, so I know I have to use my knowledge of IS 38. We have fair value, which is IFRS 13. Then I have impairment test, which is IAS 36. Okay. Question number 2 in your section A will be asked on range of accounting issues. Okay, that means you have to use more than one standard. Multiple standards you have to use for different issues. And then last question is an ethical question, and your 2 professional marks are asked in your ethical questions. Okay. Requirement A, discuss the accounting treatment. It's mostly thus only accounting treatment only. That should be adopted to address each of the above 3 issues. There are 3 issues and 3 different standards to deal with 3 accounting issues. Okay. Mark is given against the 3 issues. B, discuss the ethical issues arising from the above scenario. The same scenario, but you have to discuss the ethical issues. One is known as the accounting issues, the other one is ethical issues. Accounting issues, you have to use the standards and have to tell the rule. That as per the rule, this is the way you have to recognize or measure or de-recognize or whatever it is. And if it's ethical issue, you have to use your 5 ethical code of conduct, that is professional competence and due care, professional behavior, confidentiality, integrity, objectivity, and link this with the case study and see which one out of those 5 are breached and what are the actions that an accountant has to do. Okay, so this is the way you follow ethical answers. First, always start by writing the accounting issues. Ethical questions should be always attempted at the end. Okay, now I'm going to go through this one. Now it's your option, choice that you can answer this questions in any order. Any issue you can take first and solve it. Okay, the marks is given here, 3 marks, 4 marks, and 5 marks. But it's my practice that I always follow the order, because see, anyway I have to do it. Whether I do this or that, I anyway have to do all. So I don't waste so much of time thinking to decide which one should I do first or which one is easier. Because how will you know if something is easy or not? You definitely have to read everything, and then you will come to know, okay, this is easy, this is hard. By the time I will be losing a lot of my time. So I don't do that. I automatically start, whether it's easy or hard, I still try to do in the time allocated to me. I try to solve it. Okay, unless it's very tough and I'm not going able to get any answer, then what I do, I don't waste time. I go to the next question so that my time is saved there. Later I can come back and do it. Okay, so I will be starting with the intangible asset first, and then fair value, and then the impairment. But before reading any of the 3 issues, you should always start reading the background. It's important that you read the background. Jonjon is a public limited company that prepares financial statements in accordance with IFRS. Johnson had a number of bank loans which are repayable if it breaches its covenant. It has bank of bank loans. So the moment you see this, that the company has a number of bank loans, that means what? Definitely the company is not performing well. That's why they are taking bank loans, right? Which are repayable if it breaches its covenant. So the covenants are based on profit before tax and reported assets. A new accountant has recently started working at Jonjon and has discovered some issues relating to the financial statements for the year ended 31st December 2005. It's a new accountant. So these are some very important facts. This also helps you in accounting, ethical issues also, as well as accounting issues. Okay. So let's start with intangible assets. Johnson's statement of financial position includes an intangible asset. This asset is a portfolio of customers acquired from a similar business which had gone into liquidation 2 years ago. The accountant has asked the finance director why the asset has not been amortized in the current period, because we know that if it's an intangible asset, guys, you have to amortize it. If it does not have an indefinite useful life, you have to amortize it. Okay. So this question, when you're answering it, okay, please, when you're reading also the case study, definitely will be reading the requirements first. So you know there are 2 things. One is ethical issues, one is accounting issues. So this answer you can use from both the ways. You can put this answer in both the places. First, we'll be solving definitely the accounting issues. We'll be talking through IS 38, how to do this and whether it has to be amortized or not. Then we are going to talk the same thing, but from the ethical perspective. So make sure that you highlight it and keep the words ready. Okay. The finance director suggested replied that the change that he changed the assessment of the useful life of the intangible asset from infinite to indefinite. Finite to indefinite. This also you can ask use as an ethical issue, because just like that you cannot change it, right? Finite to indefinite. There should be something, some evidence has to be there that why it is indefinite. Okay, this is a second problem. One is not amortized. Second is they change the useful life. Two issues. Okay, one is for this, the other one is for this. Next, he justified this on the grounds that it is impossible to foresee the length of the intangibles assets useful life due to a number of factors such as technological evaluation and changing customer behavior. So one is this one, the other one is this one. He's still justifying it based on this three grounds. This is another point. Okay, so before I go to fair value, I will solve intangible asset, because I have this habit that as soon as I read one accounting issue, I'm over with it. Reading it, I start answering it rather than reading all the three different accounting issues and then answering it. But it's up to you. You can do it any way you feel like doing. You can read all the whole case study and then answer one by one, or you can read one and then answer, then again read, then answer. So I do the second approach. Now let us go to the answer. Okay. But before answering, let us go through some key answer tips, because these are very important from the examiner's point of view they have given you. Okay, this is an ethical case study style question. You need to talk about the impact of the transactions on the financial statements and the ethical issues raised. There are two professional marks for the application of ethical principles. Make sure that your ethics is not too generic. Don't give your ethics answer in a very generous way. General way. You have to be very specific to the case study you have to talk. For example, when you're writing ethical issues, you have to mention especially the intangible assets, the impairment, and the fair value. Okay. Now let us go through intangible asset. When you are answering different accounting issues, please make sure that you use a proper subheading, and subheading should not be a long sentence. Subheading should be in 2 or 3 words or one word also, if it's possible. So here the issue is intangible asset. Just use intangible asset, or you can even write IS38. Anything is fine. So which standard are you using? When you are answering this, how do you start answering this? You start by referring to the standard, which is IS38. Okay, if you forgot the number of the standard, don't write anything. Just write, if you just write intangible asset states that, it's enough. Okay, but don't write incorrect number. For example, you are writing IS36 intangible assets. Yes, you are, and all the things which you are writing is about intangible assets, but the number is wrong. You wrote IS36. Okay, there is and you know that IS36 is for impairment. So in that case, it's very confusing for the examiner to give you marks, because they are not sure whether your standard is wrong, or whether you want to write about IS36 and then everything is wrong, or whether the number is wrong and everything is correct about that standard. So don't make this. Don't avoid numbers if you think, if you're not confident, okay, now that you forgot. But rarely it happens that students forget numbers. They don't forget numbers. They should not, right? It should not be a case. But let's say you forgot, then don't write numbers. Please avoid it at any cost. And some of you might have, for example, you might have written IS35. There is no IS35 at all, no standards such as that. Okay, so you have to be very sure when you're writing numbers, especially. Okay, okay. So IS38 states. Remember, what are we talking about IS38? There are so many rules in IS38. It talks about amortization, it talks about impairment, it talks about research cost and development cost. What are we answering? That you should be sure. We are answering what is asked in the case study, the information given to you. They told about the useful life, so we have to mention about the useful life according to IS38. What does they say about useful life? Okay, so you are going to start from there. States that an intangible asset has an indefinite useful life only if there is no foreseeable limit to its useful life. Isn't it very simple, guys? If you are linking the standard to the case study, they talked about useful life, you're also talking about indefinite useful life, but only if there is no possible limit. Next, difficulties in accurately determining an intangible asset's useful life do not provide a basis for regarding that useful life is indefinite. Now you are giving the basis. Remember, it is just for 3 marks. Don't waste your time writing paragraphs and paragraphs here, okay? 2 paragraphs or 3 paragraphs also would do this. Okay, so now you need to give the facts from the case study. What did the facts told? They told that it's difficult to determine the intangible asset. But difficult in determining the intangible asset's useful life does not allow you to change the useful life from finite to indefinite according to IS 38. That's what exactly is written here. Difficulties in accurately determining an intangible asset's useful life do not provide a basis for regarding that useful life as indefinite. Because it's hard for you to measure the useful life, you cannot say, okay, it's indefinite useful life. No, that's what it means. Next. Next paragraph. Leave a line, go to next paragraph. In this case, in the case of Jonjon, so now we are specifically referring to this to the company. Because company also did exactly the same thing. So now you have to say that no, you're not allowed to do that. So in the case of Jonjon, the customer relationship is with individuals, so there is by definition a time limit to the relationship. We are talking about customer relationship. Why customer relationship? Let us go back to the case study again. Okay, here they told this asset is a portfolio of customers. Okay, what is the intangible asset? First, you should know what is the nature of intangible asset. Don't just write intangible asset because there are so many types of intangible asset. You have to be very specific. In this case, they told the asset is a portfolio of customers acquired from similar business. Okay, so it's like a customer. So when you have acquired a customer, you know that customer and a business they have a set time, specific time limit is there. You cannot say okay, they will be my customers forever only. There will be no time limit. No. So that's exactly what the answer is saying. The customer relationship is with individuals, so there is by definition, a time limit to that relationship. So because there is a time limit, you cannot change from finite to indefinite. It is against IS 38. That's exactly what they are writing. So therefore, Jonjon is contravening IS 38. And must, once you told that they are contravening, what should they do? That also you should write. This is not only for this accounting issue. Any accounting issue, same 3 steps you have to follow. Mention according to the standard what you have to do. Then you have to tell what is the wrong thing. Then you have to link to the case study and tell what they should do instead. So here they should amortize. They must amortize the intangible over its estimated useful life. Okay, so failing to do so will overstate, and if you fail to do it, what happens? Profit will be overstated because amortization is an expense. So if you are not recording that amortization, there is no expense. Profit goes up, and assets in the current period. Assets also will go up. Because remember, amortization in the balance sheet, you have to deduct that amortization from the value of carrying amount of the intangible assets. Then only you get the closing balance of intangible. So no amortization, intangible value will go up. So profit is also overstated, asset is also overstated. If you are failing to recognize amortization. So this is a proper answer, and this is the way you need to answer any accounting issues like this. Tell them what they need to do. First tell what that this is wrong, they should not do it, then correct them and tell okay, they have to do this. If they fail to do this will happen. Why they are specifically referring to the profits and the asset? Because when you are reading the background, okay, the covenant are based on profit before tax and reported assets. So for all the 3 accounting issues, remember you have to talk what's happening to the profit and what will happen to the asset if you're not, if you fail to do it, change, do the adjustments. Okay, covenant is based on this too, profit and asset. So you have to talk about all the 3 accounting issues. What will happen to profit, what will happen to asset. Okay, make an explicit reference to the impact on the error of, make an explicit reference to the impact of the error. So yeah, exactly that's what you're doing here. That's what exactly you are doing here. You are making, you are telling that what will be the impact on the financial statements if this error is there. Next, we are going to the next accounting issue, fair value. So fair value, whenever you start, you always have to start by giving the definition. Okay, so this is the definition and you can by heart this definition. Defines the fair value of an asset as the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. Okay, so till here this is the definition. Okay, fair value is a market based measurement and not an entity specific measurement. This also you need to write, don't forget to mention this always. It is not based from entity to entity. Entity does not decide fair value, it's based on the market. So it's a market based measurement, not entity specific measurement. Next paragraph. Okay, so first you start this and the next. Okay, before that I think we didn't go through that fair value. I'm sorry guys. But definitely, whether you went through fair value or not, you know that this is the step that you have to define fair value anyhow. So Jonjon owns an investment property. Please make sure which type of property you are using, because when you're using fair value, it depends on the type of asset you are using. If it's an investment or an intangible or a tangible or a financial instrument, it differs. So this is an investment property, IS 40, that are measured using the fair value method, because you know investment property you can measure using two methods. One is cost model, one is fair value method. Okay, the accountant has discovered that fair value is calculated as a new build value less obsolescence. How did they calculate fair value? New building value less the obsolescence. And if you went through fair value, we know that this is not the way to calculate fair value. That means this is wrong. Now you have to correct. Accounting issues means that only. You will be finding some error, some mistake is there in the way they calculate or recognize. What you have to do? You just have to correct it using the standard. So valuations are conducted by the finance director. Valuations are conducted by whom? Finance director. But we know that when it's a fair value, valuation should be conducted by some expert, the ones who are professional in this, who are expert in valuing such things, not finance director. In order to determine the obsolescence, the director takes account of the age of the property. So they see first what is the age of the property and the nature of its use. Okay, sales values for similar properties in similar locations are available. Okay, so you can see that the sales value for similar properties and in similar locations are available and are significantly less than the fair value estimated by the director. So you can see there is an issue here. If a similar value is there already, why are you using a value which is predicted by the director, finance director, right? There's something illogical. It's not even going by the logic. So that's why we mentioned this thing, that it is a market-based measurement, not an entity-specific measurement. That means the measurement that you get should not be measured by your finance director. It should be measured by some expert professionals who are good in valuations. Next paragraph, you have to talk about what. How do you know what is the next thing? They talked about valuations. So this means that you have to talk about level 1, level 2, level 3 only. This is a knowledge part. Please understand. More than application to the case study, this is more like a knowledge part of it. How do you value fair value? Using three levels, level 1, level 2, level 3. You have to write this in your answer. That's what they are asking, right? They will never ask you directly, okay, what are the three levels of fair value measurement? No, but indirectly you have to write this, because you measure fair value using these three methods only. The three-level hierarchy, I would say. Okay? And briefly you have to explain, not give details and details, no. Briefly, because it's just for 4 marks for each level. One line is enough for each level, okay? And always you have to prioritize level 1 over the other 2 levels. So we know that fair value measurements are categorized into 3 levels, okay? It is based on the type of inputs that they are using. First, let us start with the level 1. Remember, level 1 is the most safe. Okay, if level 1's inputs are there, you should always go by the level 1, because it is the most safest, and the level 3 is the most dangerous. We always usually try to avoid. But if we are not getting any input from level 1 or level 2, then the last resort is level 3. Otherwise, we don't use level 3. Okay, and level 2 is definitely somewhere between level 1 and 3. It's moderate, neither too good, neither too bad. So let us see what is level 1. Level 1 inputs are unadjusted quoted prices. That means you don't have to adjust this. As it is, you can take it. This is usually for identical products. Let's say, for example, I'm having a pencil with me. If I sell this pencil, or if I want to know what is the price of the similar pencil, I will definitely get it from the market, because there are so many identical pencil to my pencil. Or let us forget about pencil. Let us take some more luxurious good. Let me take a car or my mobile phone. If I want to know the price of a similar model, the same model, I can easily get it, because there's a market. There's an active market for it. Active market means buying and selling of that good is in a huge transaction. So the prices are also very common. It's okay, unadjusted. You don't have to adjust the price. Quoted prices, okay, for items that are identical to the asset being measured. Same. Level 2 inputs are quoted prices other than those included in level 1. They do not come in level 1, okay, but they are quoted prices. Okay, you can say not exactly identical, but you can say similar, right? Very much similar. Little differences are there, but overall it's similar. Level 3. Level 3 inputs are unobservable. You cannot observe those inputs, okay? And they are based on how? Management assumptions. For example, when you're finding the present value of the cash flows, you're discounting your cash flows to find the present value. These are like some assumptions you're using. This is very risky because there is not a price, okay? The price is not verified. It's based on assumption. So if your assumption changes, price fair value also will change. So in this case, what you have to do now, you have to see out of this three level, in which level are you measuring currently and which level you should actually measure correctly. Okay, so now just read the tutorial note. Until here, students can write. That's a good thing. Bad thing is from here onwards, students struggle to write. Application to the scenario. So now is the time to apply your knowledge to the scenario. What type of level of input Jonjon has used and what level of input is available for them to use. You have to see what they are using and what is available for them. Okay. So you start with by saying the nature of the investment property. You have to understand what type of property it is. Because some assets are easy. There is an active market. You can easily get the prices. Not all the assets are like that. For some, it's hard to get. There, if you are using level 2 and 3, it is justified. But we have to see whether for Jonjon, it is justified or not to use the fair value that was predicted by whom? Finance director. So it's more like management's assumptions. It's more like level 3 they have used here. So due to the nature of the investment property, which is often unique, we know investment properties are kind of unique properties and they are not traded on a regular basis. Okay, and the subsequent lack of observable input data for identical assets, because it's unique, definitely you will not have input data for identical assets for fair value measurements. So they are likely to be categorized in this level 2 or level 3 valuations. Level 1, it will not come there. Okay. Now we are discussing level 2 and level 3, referring this to the case study. So level 2 inputs are likely to be the, in this case, it is likely to be what? Sales price per square meter for similar properties in same location. Or you can see the rent, the market rent, observable market rent. This is not exactly the same, but similar. So you can use level 2. And the property yield from the latest transactions. So all this you can use as level 2. If you are having this type of inputs, you can use level 2. Level 3 inputs may be yields based on management estimates, for example, cash flow forecast using entity's own data. This is a level 3. Assumptions about the future is also level 3. Future development of certain parameters such as rental income. You are assuming that rental income will increase by 5% in 5 years. You are assuming. So it's level 3 that are not derived from the market. This level 3s are not derived from the market. It's your own assumptions only. So now you have to see in the case study what they have done. Management should maximize the use of relevant. They should maximize the use of relevant observable inputs and minimize the use of unobservable inputs. That means as much as they can make use of the observable input, if and try to minimize the use of unobservable input. Okay. So valuation based on the new build value less obsolescence, right? This is the way they have calculated, right? The fair value. So they have valued based on this one, new value less obsolescence. This does not reflect the level 2 input. This is not a level 2 input which are available, such as sale prices. Sale prices, okay, I can understand. Sale prices, they are available. You can level 2 input you can find, but not for this one. New value less obsolescence. So, and you know that level 2 data is available. How can you say it's available? How do you know level 2 is available? You need to go to the case study again and see there. Sales value for similar properties in similar locations are available. You see, sale value, sale prices, they are level 2 input. It is available. Then why should you go and use level 3? You have to use level 2 only. Understanding? So, as level 2 data is available, Jonjon should have used this. You see, you are correcting them. They should have used this rather than level 3 when valuing the industrial property. Now, it's a fair value. When it's a fair value, There will be some gain or losses also on the revaluation. Don't forget this. This is the last thing which most of the students, most I would guarantee, forgets about this. They stop till here, I would say. But don't forget, whenever the fair value model is adopted, I'm not talking the cost model, I'm talking the fair value. Fair value keeps changing every year. It's not that once you do fair value and over. No, every year you have to change the fair value. You have to update it. So when you're updating on the revaluation, there'll be some gain or losses every year. You need to recognize this. And where will it go? This is an investment property. Remember, if it was a normal, if it was your property, plant and equipment under IS 16, it would go to other comprehensive income. But this is for investment property, which is your IS 40. So for IS 40, your gain and losses on revaluation goes to statement of profit or loss. It's very important that you know these things. Gain or losses on revaluation of investment property are reported in the statement of profit and loss. See, therefore, overestimating the fair value of the property. Now you have to tell what is the impact if the error is there. Same like how we have done for intangible assets. Now we are saying for the fair value. If therefore overestimating the fair value of the property will overstate profit and assets. You see, if all the three accounting issues you have to say this, whether profit and assets are overstated or understated. Because remember, in your ethical questions, you need these answers. Okay, so profit are overstated, assets are overstated. Same like the intangible assets. How profit is overstated? Because you will recognize a gain on revaluation. Sorry, when you're overstating the fair value. So when the fair value is more, there will be a gain for that. So that gain will be recorded in the profit and loss. So profit will go up. And same for asset, fair value of the property. So you'll be showing a higher amount of the asset in your statement of financial position. Therefore, both profit and assets are overstated. Now let us go to the third issue, impairment test. Okay, let us read the case. And this is worth 5 marks. So let's see. Jonjon has three main cash generating units, CGUs, which have goodwill attributed to them. The finance directors asked the accountant to perform an impairment test of the CGUs. Okay. Using the most recent financial forecast as the basis for value in use calculations. The realized cash flows for the CGUs was negative in 2005. The cash flow was negative in 2005 and the far below forecasted cash flow for that period. The directors have significantly raised the what did they do? Significantly, they raised the cash flow forecast for 2006 with very little justification because they saw in 2005 there was a negative, right? So it's very unethical that suddenly in 2006 they are increasing very much. This you can use in the ethical issues also. Okay. So the projected cash flows have been calculated by adding back depreciation charges to the budgeted result for the period with expected changes in the working capital and capital expenditure not taken into account. They have added back the depreciation charge, okay, to the budget result for the period with expected changes in the but the changes in the working capital and the capital expenditure are not taken into account. But you have to take this into account. It's not taken into account. Then the finance director has told the accountant. What did they tell? That the future promotions and the pay rises are dependent on the following these instructions. So they very clearly know that their instructions are wrong. Still, they are telling them to follow it. So this is an ethical issue. It's like he's threatening the accountant that if you don't do as I say, you will not get the promotions and also your pay will not rise. Okay. Now first let us solve the accounting issue. Make sure that you know you identify what's the exact problem. Then it's very easy to solve. Okay. So we are going to talk about that. What are we going to talk about? Talking about cash flow forecast. That means value in use. The main thing is how do you measure value in use under IS 36. This is our main topic under IS 36. This is the issue you are having, right? The problem is here only. We are not going to say, okay, whether there are indicators are there, assets are impairing. No. The main thing under impairment of asset is measuring value in use. How do you measure it? So IS 36 states that cash flow projection should be used in measuring value in use. Okay, and this shall be based on, and that cash flow projections, when you're using it, remember, you have to be, it has to be based on some reasonable and supportable assumptions, not just any assumption, which represents management's best estimate of the range of economic conditions which will exist over the remaining useful life of the asset. Okay. IS 36 also states that the management must assess the reasonableness of the assumptions. You have to check the assumptions whether it is reasonable or not. Management has to do this by examining the causes of differences. How are you going to do this? Whether assumptions are real or not? You see the differences. What are the causes of differences? Why it suddenly increased when it was negative in 2005, but you can see in 2006 significantly they increased. So it looks very unreasonable, right? So you have to first find out, question, why is this difference between the past cash flow and the actual cash? Okay. Management should ensure that the assumptions on which its current cash flow projects are based are consistent with past actual outcomes. You have to see. It has to be consistent. Next. Now we are linking it to the case study. So despite the fact that the realized cash flows for 2005 were negative, you need to bring out this in your answer because this is very important that in 2005 it was negative. And far below, and you see it's far below the projected cash flow. That means the actual cash flow, it is less. It's very much less compared to the actual cash flow. That means their predictions are not so right. They are focused. So that because if their focus was right, even if it's not exact amounts, but at least it will be very much in line with it, very close. But this is far below the projected cash flow. So the directors had significantly raised forecast cash flows for 2006 without justification. What's going to happen because of this? There are serious doubts now about Johnson's ability to produce realistic and reliable forecast. So according to IS 36, estimates of future cash flow should include, you have to talk about this. According to IS 36, what should it include? This is the main thing. Once anyone identifies that we are talking about these things, then it's very easy to write the answers. Trust me. Most of the students struggle because they learned all the rules of IS 36. They know, okay, impairment is like this, but they only know that part. What about if you have to find fair value less cost to sell? What if you have to find the value in use? What if the recoverable amount, you have to talk about it? All these other aspects also you have to know how to write. It's not just that you IS 36, okay, always impair, they will be testing your impairment, which is carrying amount minus recoverable amount. No, it's not always like that because there are no numbers to you to calculate impairment. This is just for you to write. So the main thing is estimate of the future cash flow. What should it include? It should include projections of cash inflows from the continuing use of the asset. What would be the inflow if you are still continuing with that asset? Because the name is value in use, right? What is the value you are getting if you are using the asset? That's what it means. So what is the cash flow you are receiving when you are using the asset? That future cash flow should include that when you're estimating it. Okay. Next, projections of, and all these are there in your textbook, so don't worry. It's just that you don't know how to put it in an answer. From which part of the IS 36 you have to take to write an answer. That is the only difficulty. I can understand which is coming, but this all are there, trust me, is there in your textbook. You just have to structure and write it. Projections of cash outflows, and if you are not getting it in the exact place, you can check out my video on IS 36 impairment. Okay, I've talked about all this there. Next is projections of cash outflows which are necessarily incurred to generate the cash inflows from the continuing use of the asset. You will be having some outflows to incur that inflows. What is it that you have to include? Next, net cash flows to be received or paid for the disposal of the asset at the end of its useful life. When you're disposing the asset at the end of its useful life, what are the amount you have to pay or you have to receive? That, so all these three things has to be there in this estimate of future cash flows. Okay. Next, IS 36 states that projected cash outflows should include those required for the day-to-day servicing of the asset, which includes future cash outflows to maintain the level of economic benefits expected to rise from the asset in its current condition. For example, you might be incurring some expenses. Day to day, you have to service that asset. There is some cost. Your cash outflow that you are projecting should include all those costs as well. Okay. it is highly unlikely that no investments in next thing. So we are over with that one. Next we are moving towards what? The working capital. Okay, and the capital investment. Okay, because they didn't include it there. So it is highly unlikely that no investments in working capital or operating assets would need to be made to maintain the assets of the CGUs in their current condition. What does this mean? I'm sure most of you didn't understand this sentence. It is highly unlikely that no investments would be needed. Please understand, they told it's highly unlikely that working capital will be met. They didn't say that. They told highly unlikely that no investment would be met. It means that the chances are very less that you don't need any working capital. That means you need working capital. It should be there. There are more chances that working capital you have to need to maintain your assets in the CGUs, right? Working capital operating assets. So you have to include this there in your projections. So it would seem that cash flow projections that finance director of Johnson wants the accountant to use are not in compliance with IS 36. Please feel free to write this sentence if it's not complying. It's not complying. So these projections, what would happen if these errors are there? This will most likely to overstate the recoverable amount of the CGUs. Why recoverable amount? What is the recoverable amount? I will write it here only. You have to use higher of fair value less cost to sell of value in use. Okay, so if this is higher, if this is increased, your recoverable amount also will increase, isn't it? And value in use will increase because you didn't include the investments in working capital, you didn't include the investments in operating assets. All these things are not included, so definitely your value in use will go up. Most of the cost in fact you didn't include in the value in use. So what happens? The outflows. So this is likely to overstate the recoverable amount. Okay, if recoverable amount includes potentially reducing or eliminating the amount of any impairment loss. It could reduce it also or totally eliminate it also. How it can eliminate the impairment loss? You have to talk about impairment loss because it is IS 36 impairment only. At the end, you have to mention a line about impairment. Remember that, even if its value in use is the main thing. Because what is the formula for impairment? If you're not getting this right away, make sure that you write it somewhere. The formula. So impairment is carrying amount or carrying amount of the asset minus recoverable amount, isn't it? If your carrying amount is higher than recoverable only, you will have impairment. But if your recoverable is increased now, okay, and this is, let's say this is 200 and before, okay, let me explain this with numbers. I think that's better. Carrying amount was 200. Carrying amount is fixed, will only change the recoverable amount. Recoverable amount is now 100. So what is your impairment? 100. Carrying amount is still 200, but recoverable amount will increase it to 150. And what is your impairment now? 50. You see, your impairment went down. And impairment is a cost. It's a cost that you have to write in the profit and loss account. So impairment goes down, profit is overstated. You see, profit will go up. So recoverable amount higher means impairment goes down. It's an opposite relationship. That's you need to understand. If you're not understanding like this, make sure that with some numbers and all in the exam also you can do this. It won't take so much of time. I do this at times. I used to do that time, but now when I read it, I know that this is the impact. I can visualize it. That this is happening in that place. Earlier, when I was giving the exam, I was not so pro at this. I had to write it somewhere with numbers. That okay, if this is happening, this is understating and something like that. So it will reduce. It could eliminate also. Okay, eliminate why? Because let's say your recoverable amount is 200 now. So 200 minus 200 is 0. 0. Eliminated. Okay. So it could reduce or eliminate the amount of any impairment loss. This would what happen again overstate profit and assets also. How assets? How assets? That impairment loss. Okay, there is no impairment against the asset. There is no impairment against the asset. So that asset amount will be higher only. You see? So in all the three conditions, what did you find out? Whether it is intangible asset, whether it is impairment, whether it is fair value, profit is overstated, asset is overstated. Now let us go to the ethics. Please, when you're writing ethics, don't just list out the 5 ACCA code of ethics. Do not do that. Okay, and make sure that since they have talked in the background about the bank covenant, make sure that your answer make some reference to the bank covenant, that is your net profit before your net profit and your asset, because bank covenant is based on these two things only. In short, the fact that errors overstate profit and assets, you have to link all your ethical issues to this two things. And finally, they are comment to the accountant what the accountant should do at the end. So what the accountant should do at the end, the actions that you are giving the accountant to do, you will get the professional marks for that. Because exactly, even in the marking scheme, when you go through, they will not tell you that this is the how you will get the professional marks. They don't tell, they will just tell 2 professional marks. Okay, just wait a minute, I need to go back. Okay, so there is no you have read the whole case study, there is no separate thing for ethics. So you can straight away start writing ethics answer, because now you know the accounting issues, it's there fresh, the 3 accounting issues. Okay, now it's up to you how many paragraphs, how many paragraphs you want to write, 4 paragraphs, 5 paragraphs, because it is worth 8 marks, 6 technical and 2 professional marks. Okay, so this choice is up to you, but make sure that your answer don't write in one paragraph. Even though it's ethical issues, you have to write in different paragraph. Maybe the 3 ethical issues you can write in 3 separate paragraphs. The action that you're suggesting to the accountant you can write in one paragraph, which is the last paragraph. The concluding paragraph is the actions only that accountant should do. Okay, but before that you have to explain the scenario, what's happening. Okay, so let's start. How do you start? How do you start? If you start by saying whether the company is breaching the accounting standards or not, whether they are breaching one standard, two standard, or all the standards. So you start your ethical answers, any ethical answers, by this line only, that the company is breaching accounting standards. So in this case, the company has breached several accounting standards. You see, this is your first line. This is how you start build up your ethical answers. So breaching is also unethical. Breaching accounting standards is unethical. You don't write by saying, okay, this company is unethical. This company has to be sued, is unethical. They have to be ethical. So please don't go and write in your solution, sorry, in your recommendation, the actions that you are giving to the accountant to be ethical. We all know to be ethical, that they have to be ethical, but how? What are the action? What are the exact steps the accountant has to follow? That you have to write. Don't go and write be ethical, be ethical, be ethical. Okay, let's come back to the answer. So Johnson has breached several accounting standards. All of these breaches overstayed. You see, it's very easy to say because we have already wrote in our accounting issues that all of the breaches overstated the reported profits and assets. Did you see? They're very specific to these 2 words, profit and asset, because your debt covenant is based on that. Because if you breach the debt covenant, you are unethical. Okay. So what happens when you're breaching it? What's the next line? Next line you are going to say what happens if they are what will be the outcome of this when it is breached. This will make the performance and the position. Performance means your profit and loss, and position your statement of financial position of whom? Of the company, Jonjon, appears much stronger to the users of his financial statements. This you have to write. This is the impact of that higher profit and asset. Okay, so your first paragraph you can give. This is like a background you are giving. So in particular, it will reduce the likelihood that Johnson will breach it. So in particular, remember to bring everything back to the loan covenant or debt covenant, anything. What would happen to this? Whether they will breach or not. Everything you have to bring back to this only. Because the whole ethical issue is this on this one thing. Whether they are breaching the debt covenant or not. Okay. So in particular, it will reduce the likelihood that Johnson will breach his debt covenant. That's what Jonjon wants. Sorry. It's not Johnson, it's Jonjon. Okay. Uh, So everything is about it that they are not breaching, but in fact, in reality, what's happening? They are breaching. They are breaching. But by doing this, by overstating profit, they are showing that they are not breaching the debt covenant. They are concealing the true fact. Okay. Next paragraph. Okay. leave a line, go to the next paragraph. What is this next paragraph all about? It's about their responsibilities of the company, responsibilities to the shareholders, responsibilities to the public, responsibilities to the various stakeholders, to the bank. Okay, so the users of the financial statements, such as banks, could be banks in this case because they have given a debt, a loan. Remember in your background, okay, bank loans. They have number of bank loans, and this bank loan you have to repay immediately if they see the bank says that you have breached any of its covenant. That's why this is very important. The ethical issue is on this. So bank is major user of this financial statements in this condition, and shareholders also definitely. So the users suggest don't give all five six types of stakeholders. Okay, the users, no, two or three is enough. The very main, according to your question, in this question it's bank and the shareholder. Okay, so the users of financial statements, what do? They trust accountants. You have to talk about this thing. This is very similar. This you can copy paste also to any question. The first is giving you the scenario to the case study, what's happening. Second one, it's like that they have to build their trust. They are accountable to the user. All those things. Okay, so they trust the accountant. Please see, it's not, we are not talking about the finance director. They trust the accountant. Accountant is the one who's preparing it. Finance director is directing them, but it is the accountant who will be blamed if anything goes wrong because he prepared it. So trust accountants and rely on them to faithfully mention these words, relevant, faithfully represent. These are very important words. Trust accountants to rely on them to faithfully represent the effects of the company's transaction. We all do that, right? We believe, we have this faith on them, the accountants, that whatever they are preparing, it's correct. It is actually faithfully they are representing the company's actual position. That's what we all normally do, right? No one asks questions from accountants. We don't have that doubt. So that's what even the banks and the shareholders in this case are doing. They rely on it. Okay, IS1. They're talking about IS1. Because presentation of financial statements. What does IS1 says? It makes it clear that this will be obtained when accounting standards are correctly applied. Okay, you have to talk about IS1 because in IS1 it is about presentation of financial statements, and here they are not doing it. That means they are not following the accounting standards correctly. So nonetheless, incentives might exist to depart from. So this in here, second paragraph, it's more like you're giving the opportunities why they are unethical. What are the opportunities that could happen, or situations? So in this case, incentives might exist. This could be an opportunity for them why they are departing. So incentives might exist to depart from IFRS and IS standards. Okay, because they are not following the IFRS standards. So you can say, okay, there could be some incentives that they are departing it. It is therefore vital that accountants comply with HSCA's code of ethics. You have to write it. Maybe I would say you can memorize it and keep one ethical answer, and you can just copy paste and change, adjust wherever you have to adjust according to the situation. Okay. Now, third paragraph. You are giving reasons why they might breach it. So one reason could be, it may be that the breaches of accounting standards are due to lack of knowledge. Try to give as much reasons as you can think of. Not everyone might think of this lack of knowledge. Some of you might think of some other points. So it does not matter whatever the points you are giving. If it's not matching with the answer which is given to you, it does not mean you're wrong anywhere. You still will get marks if it's correct. One could be lack of knowledge. Yeah, they might not have the lack of that knowledge, that standard. So nonetheless, as per the code of ethics, accountants have the responsibility to ensure that they are technical. This line is repeated. Okay, accountants have a responsibility. This was a very important that you write. Accountants have a responsibility. They have an accountability. To whom? To ensure that they're technically competent. Technically competent. You cannot say I don't have knowledge about it, so I'm correct. I can justify the mistakes I did. No, you have to be. It's your job that you have to be technically competent enough. The accountant, okay, we're referring this everything to the accountant till now. We still didn't go to the finance director threatening the accountant. We'll go there. However, the number of errors and fact, they have made number of errors, and the fact that they are consistently overstating assets and profit, isn't it? All the three situations they are overstating assets and profit. So they are very consistent in that. So what does this suggest? This suggests that the breaches of accounting standards are purposeful. Purposely they are doing it. Because error or lack of knowledge happens only once. Very rarely it happens that you don't have a knowledge about some area, or maybe a new standard came up, I didn't know about it, that's why you made a mistake. But this is not like that. All the three situations they are overstating profit and asset. So it looks like that is very purposeful. If so, the directors of Johnson lack. So if so, the directors of Johnson, what does they lack? Very important. You have to exactly say what are they lacking. Out of the 5 code of ethics, okay, whether it is integrity, whether it's object, whether it's confidential, whether it is professional competence and UK, or whether it is professional behavior. Out of this, which one? Okay, definitely it is integrity. See, integrity and objectivity, most of the ethical questions have these two things, but other than this, other things also can come. One is integrity. They are not honest. They are not straightforward. Objectivity, they are not objective. Why? Because their decision is biased. Why? Because the loan which they have taken is based on two things. One is assets, one is profit. Both of them should be high. So they have a self-interest there. Because they have a self-interest, they cannot take a decision objectively. Who is lacking it? It is the director, not the accountant. Accountant is forced to do by the director, but they still didn't do it. Accountant is the one who is telling them, the accountant, to do this, do this. So they lack the integrity. They are not honest. They are not independent also. They have a self-interest. Motive. So lack of integrity and objectivity. Just see how the other three they didn't write about it. Confidentiality, they didn't mention anything in the case study regarding keeping information secret or not concealing it or confidentiality, nothing like that. So you don't have to write it. If you're writing it, you will not get any extra marks. No marks will be cut, but you will not get extra marks. Professional behavior also they didn't talk because they have not done anything which brings discredit to the profession. And professional competence and due care, no, because professional competence and due care you can write when they don't have the knowledge. But this is purposefully done. So you cannot write professional competence and due care in this situation. So it is only the first two code of ethics that has been breached: integrity and objectivity. I hope this is very clear and you're now understanding how to write an ethical answer. The last paragraph is the instructions that you will tell the accountant to follow. This varies from students to students, okay? But my suggestion is go through this. Don't memorize word by word, but just follow the steps. If you have seen my other videos, the previous questions on ethics, you will know what are the steps. So it has been suggested that accountant would suffer. Now you're talking about the accountant. What are the issues they are facing? From the accountant's point of view, think they are suffering. Okay, so they would suffer financially if the job is not there, right? They would suffer financially if the finance director's instructions are not followed. Before you go to the action, make sure that you have to write these things because professional marks is there already. How you structure your answer. Professional marks does not mean you're writing 2 points extra. That's not how professional marks work. Technical marks might work like that. The 6 marks that you're getting, but not the 2 professional marks. Professional marks works on how the first of all your tone of writing. Number two, how you're structuring it. Okay, whether the advice you are giving, is it practical? Okay, so this is inappropriate. Definitely, all the director's instructions are inappropriate, as it creates a risk that the accountant will prioritize their own interests above those of Johnson's stakeholders. Isn't it a risk? It's a risk that accountant might prioritize their own interest. The accountant should discuss the matters with the finance director. Number one. So this is from here onwards. from here to here. This whole paragraph is your advice. What they have to do, actions that accountant should do. You are giving these actions, and these actions are what I would say. Memorize it, copy paste this into any ethical answers. You can put these things exactly the same, and it should follow this order only. Don't go and say the accountant should not do job there. He should look for some better jobs. He should resign from there. Resignation comes at the end. So the accountant should discuss the matter with the finance director. First, discuss the matter with the one who has threatened you. In this case, this is the finance director. Second, keep a record of these conversations. Definitely. If disagreements still exist, what should they do? Seek professional advice from ACCA. Second action. Third, accountant could also or should also approach other company directors, including NEDs also, non-executive director. That is the third action. Fourth action, if the matters cannot be resolved, then the accountant could consider resignation. So this is the fourth step. Make sure that you follow these four steps in their respective order. Don't change this order. Any ethical answers, follow these steps. Now we'll go through the marking scheme to see how the marks are awarded. For ethics, if you discuss the ethical principles, it's just 2 marks. Why 2 marks? One is for breaching integrity, the other one is breaching objectivity. And 4 marks application of it to the scenario. And 2 professional marks, they didn't say how. Coming to the first one, they didn't show the breakdown of the marks. So that means if it's intangible asset, write 3 points, fair value 4 points, impairment 5 points. That's how you're getting the marks. So that's it for question number 21. See you in the next question 22. Till then, take care and don't forget to subscribe to my channel because I desperately want 1K subscriber. Okay, I just need 200 subscribers more, because as soon as I go 1K subscriber, I can have lot of features and it will be beneficial for you guys as well. It will definitely benefit me, but more than me, it's your beneficial. I can have the community tab there, which will be enabled for me, through which I can make you know in advance what are the videos I'm going to upload and all. Currently I'm not able to do it because I'm less than 1K subscribers. So please guys, help me to reach that 1K subscriber. That's all what I am asking from you. And because I'm going to complete my 1 year soon on my YouTube. So before the 1 year gets over, make sure that I do reach 1K subscriber. Okay, so that I can give you more and more benefit, because as soon as I reach that 1K subscriber, so many opportunities are there availing. I can avail. Okay, I can have a super chat with you guys. I can go on live streams. I can do so many other facilities are there, which is right there, not there for me. Okay, so please guys, just share my videos, my contents, the description of my channel, everything is given there. Do go share it out with your friends and make sure that they actually subscribe. You can tell them to subscribe. All right, so take care and see you in the next video.